I'm tired of pretending that I understand credit cards, and I bet you are too. You swipe, you smile, but deep down, you have no idea how this thing actually works. What's a grace period? What the hell is a utilization ratio, and why does your credit score drop when you pay something off? Everyone acts like it's easy, but the truth? Credit cards are designed to be confusing on purpose. The more confused you are, the more mistakes you make. The more mistakes you make, the more money they make off you. But starting today, we kill the confusion. I'm going to explain credit cards like you're 5 years old because honestly, that's how they should have explained it to us in the first place. Forget everything you think you know. A credit card is just a rich friend who lends you money. That's literally it. You want to buy a $100 pair of shoes. You don't have $100 right now. Your rich friend says, I'll pay the store $100 for you. Just pay me back later. The store gets their money immediately. You get your shoes. Your friend gets paid back when you have the money. That's basically credit. Now, the card part is when that friend of yours gives you a magic wallet where you carry the $100 from. A credit card company is just that rich friend, except they're not actually your friend. They're a business, and they make money when you can't pay them back quickly. Your credit limit, let's say $2,000, is how much this friend is willing to lend you at any given time. Use $500, you can still borrow $1,500 more. Pay back that $500, now you can borrow the full $2,000 again. Here's where it gets sinister. Remember our rich friend? Well, if you don't pay them back by a certain date, they start charging you extra money called interest. And this interest, it's not like 2% or 5%. We're talking 18%, 25%, sometimes 29% per year. Now, this friend isn't completely evil. They give you what's called a grace period, usually about 21 to 25 days after they send you the bill. It's like they're saying, hey, I know you're good for it. Here's some extra time to get the money together. If you pay them back the full amount during this grace period, they don't charge you anything extra. You literally borrowed their money for free for about a month. Let's say you owe your friend $1,000 and you can only pay them back $25 this month. Your friend says, okay, but since you're keeping my $975 a bit longer, I'm going to charge you about $20 extra this month. But here's the kicker. Next month, they charge interest on the original $975 plus the $20 interest you couldn't pay. So now you owe interest on interest. Keep paying just $25 a month, and you'll end up paying over $2,000 total. It'll take you 4 years to pay off that original $1,000. From their perspective, you just made them $1,000 for basically doing nothing. They lent you $1,000 once, and over 4 years you gave them back $2,000. This is why they don't want you to understand. Confusion equals profit. They make billions from people who don't fully get how this works. But you're about to stop being one of those people. Now let's talk about your credit score. That mysterious number between 300 and 850 that apparently controls your entire financial life. Think of your credit score like your reputation for paying people back. Imagine all your rich friends get together every month and gossip about you. Did Sarah pay you back on time? How much money does Tom still owe you? Is Jessica always asking to borrow money? Your credit score is basically their group chat turned into a number. 35% of your score is just, do you pay your bills on time? If you always pay your rich friend back when you said you would, they tell everyone you're reliable. 30% is your utilization ratio, how much of your available credit you're using. This is like, if your friend is willing to lend you $1,000, are you always borrowing $990 of it? Or do you only borrow $200 here and there? If you're always borrowing close to the maximum, it looks like you're desperate for money, like you're living paycheck to paycheck and always need help. But if you only borrow small amounts occasionally, it shows you're financially stable and just using the convenience. 15% is how long you've been friends with this person. Or in credit terms, how long you've had credit accounts open. A 10-year friendship where you've consistently paid back small loans carries more weight than a 6-month friendship. 10% is your credit mix. Do you only borrow from one friend? Or do you have relationships with several different types of lenders? Having a credit card, a car loan, and maybe a mortgage shows you can handle different types of debt. And the last 10% is new credit. How often you're asking new people to be your rich friend. If you're constantly asking new people to lend you money, that looks desperate. But occasionally finding a new lender with better terms, that's just smart. And why does your score sometimes drop when you pay something off? This is where the system gets really weird. Let's say you have two rich friends. Friend A lets you borrow up to $1,000. Friend B lets you borrow up to $2,000. So you can borrow $3,000 total. You owe friend A $500 and friend B $300, so you're using $800 of your available $3,000. That's about 27% utilization. Now you pay off friend A completely and decide you don't need them anymore, so you break up, close the account. Suddenly, you can only borrow $2,000 total just from friend B, but you still owe $300. Now you're using $300 of $2,000 available. That's 15% utilization. Wait, that should be better, right? Lower utilization? But sometimes your score drops because you also lost the credit history with friend A. If friend A was your oldest friendship, you just shortened your average relationship length. The system is weird like that. This is why credit experts tell you to keep old cards open even if you don't use them. It's like keeping old friendships alive. They boost your reputation even if you don't actively hang out. All right, now that you understand the game, here's how you beat them at it using our rich friend analogy. Rule number 1, never borrow money you don't already have. This sounds backwards, but here's what I mean. If you have $500 in your bank account, you can put $500 on your credit card. You're not actually spending money you don't have. You're just timing it differently. Remember that grace period? That's 21 to 25 days where your rich friend doesn't charge you anything. So you buy groceries with their money on the 1st of the month, but you don't pay them back until the 25th. Your $500 stays in your bank account, earning interest for almost a month, then you pay them back. You just got a free short-term loan. Rule number 2, pick a rich friend who gives you rewards for borrowing from them. Some give you 2% back on groceries. Others give you points for travel. You're going to buy food anyway, might as well get paid for it. Rule number 3, always pay the full amount back during the grace period. This is how you keep your rich friend relationship healthy. They lend you money, you pay it back in full, they reward you with cash back or points, and they tell everyone how reliable you are. Do this consistently, and something magical happens. Your reputation score goes up. More rich friends want to lend to you. They start competing for your business with better rewards and lower interest rates if you ever need them. You go from being someone they're trying to trap to someone they're trying to keep happy. Banks start sending you pre-approved offers with better terms. You become the person they want to lend to, not the person they want to profit from. So the next time you swipe and smile, you'll actually know what's going on. And that changes everything. If this finally made credit cards make sense, hit subscribe. We break down the money game one trick at a time. No fluff, no jargon, just the truth. Still confused by money? Watch this next video. We'll break down whether a minimum wage worker can actually survive in 2025.